Okay, for the purposes of this demonstration, I'm just going to do something very, very simple. We're going to take a look at two charts. One is the NASDAQ 100, and these are the micro E-mini futures. You don't have to worry about what those are right now, but they're future contracts. And they are leveraging the NASDAQ 100. Okay, so there's some leverage there. The advantage is that you don't have to put very much money up in order to purchase or sell these. And on the left side, I have the E-mini Russell 2000 index futures. These are the micros again. Typically the margin requirements are just a few $100s if you hold it during the day. If you hold it longer than that, it might be a couple $1,000s if you want to hold it overnight. But generally, you can get started with less than $2,500 or $3,000, or you can do more. But generally, the minimum is about $2,500 to $3,000 for these contracts, and they are leveraging these indexes, the NASDAQ 100 and the Russell 2000. Now, what we're going to do is a simple demonstration of what happens when, as you see in the charts in front of you, they both look like they're going up. It looks like there's a swing higher here on both the NASDAQ 100 and the Russell 2000. That's not what we do. So what we do is we've taken hedge fund methods and strategies, and we've turned those into something that the average trader can use to make more money. Now, hedge funds have gotten a bad rap over the last few years because they have had generally minimal or smaller returns than they used to. Now, if you go back to the 1960s and 1970s, some of the very first hedge funds were making unbelievable money. They were making 40%, 60%, 100% every single year on the money that was invested with them. And there's something called the law of large numbers. And so what happened was when they were using small numbers, when they were trading, the hedge funds started trading with it $1 million or $500,000 or $2 million or $10 million. And when they started getting into the hundreds of millions of dollars, the law of large numbers started to play out. And that law of large numbers says that the larger you trade or invest or do anything, the smaller the returns get. And so what happened was those 30, 40, 50, 70, 80, 100% returns that hedge funds were getting back in the 1960s and 70s and 80s, they got a very large following. So a lot of people, the word got around that hedge funds were making a lot of money, and so when they started making a lot of money, more and more money came to them to trade, to use, to invest. And so large investors started flocking into hedge funds. And so as those funds got larger and larger, it was harder and harder in order to generate those large returns. And instead, now they're returning maybe 2, 3, 4, 5% if they're lucky. There's very few hedge funds that do larger than that. There's one or two that do, maybe 20, 30% a year, but that's the max now. Unless it's a brand new fund that has a small amount of capital and they haven't run into the law of large numbers yet. But we can use the same strategies that hedge funds can use in order to protect themselves in the market and make outsized returns by using smaller capital bases. So as an individual investor, if you have $50,000, $100,000, $200,000, $500,000, or $1 million or more, you can invest those relatively safely in the market and make outsized returns. And the way we're going to do that is and I'll show you how hedge funds strategies can be applied to individual accounts. See, this was not actually probably possible 15, 20 years ago because the tools were not available. The tools at that time were only available to hedge funds, and that's why they were able to make outsized returns. Now, with the power of the internet and the technology that's developed over the last 15, 20 years, those same tools are now available to individual investors. And unless you've been in the industry, unless you've been following the developments of the technology, you probably have not really observed why all of a sudden this is possible. Because number one, you'd have to have knowledge of the strategies, and then you'd have to have knowledge of the technology and the developments that have taken place in trading and in investing over the past 10 or 15 years, especially with the development of the internet. Now, so that's kind of like where we are. All of a sudden, those hedge fund strategies that made 20, 30, 40, 70% a year returns possible back in the 60s and 70s and 80s are now available to you as an individual investor because of the technological developments. And the law of large numbers is now being applied to hedge funds, but it's not to you because you still have a relatively small capital base. All right, so let's get into this, and I'll show you exactly what I mean. So now, a typical retail investor might say, okay, this looks like a great chart. I'm going to go long. I want to go long the NASDAQ 100 because it looks terrific, and I'm going to use the smallest contract possible, the micro E-minis, because they are not as volatile. I won't lose as much money, maybe because they are micro contracts, so they're very, very small dollar amounts that I'm dealing with here, and I can get into the contract for probably about $1,500 in margin, or even less if you're doing a day trade. I don't recommend day trades, but you can do those. That's not the strategy that we're doing. We're trying to develop not only a return, but safe returns based on the amount of capital that's invested in using hedge fund strategies. Okay? So let's do this. Let's do this as an example. This is just an example. So right now, we are at March 3rd. This is March 3rd at approximately 2 p.m. in the afternoon. And I'm using TradingView.com for this example. TradingView.com, in my opinion, is probably one of the best platforms that you can be on in order to trade. You can connect. It's a platform. So in other words, you can have watch lists, you can have charts, but you can connect to your own broker. There's a number of different brokers that they can connect with, but you use this platform in order to trade. So let's do the example, and then I'll come back and I'll kind of explain exactly what happened and why we did what we did. So as I mentioned, this is March 3rd at 2 p.m. in the afternoon. You see the NASDAQ rising. We're on a 1 hour chart. So each one of these bars is 1 hour in length. And it looks like the market has started to go higher for the NASDAQ 100. And so what we want to do is we're going to buy a contract, just one, about $1,500. And then we're going to fast forward this. I'm using the replay function on TradingView because the date of this video is several weeks in the future. And we're going to play it back and see if we if we hold on to this long enough, are we going to lose money or are we going to make money? So I'm going to hit the play button. It's at 3x, so it doesn't take too long to go to the present day. And I'm just going to hit it play, and then we're not going to get out of the position. We're just going to let it go and see exactly where we stop, if we make money or we lose money. So let's go ahead and hit play. Say initially we're making money. Initially, we started making money because it looked like, hey, everything is going to go up, right? But it does fluctuate quite a bit. So as you can see, we went negative. So if you weren't fast enough to catch your profits here, all of a sudden this became a negative trend. Okay, so maybe it'll go positive. Maybe this is a temporary setback. There we go. Oh, we missed that $36. Oh, no, now we're down 500, 800, 700, 900. We're down significantly on this position very, very quickly. Now we're down 1,000, 600, 700. You can see the fluctuations. If you were just to purchase this one contract, there's a great deal of fluctuation in your account, And so what's happening here, oh, you got to have a chance here to get out at a little bit of a plus. Oh, you missed it. Oh, now you can get out at $500, $600, $700. The fluctuations are pretty amazing. We went 1,000 negative, now we're 600 positive. So we're still positive. So now we're saying, oh, this is good. Okay, we're going to continue to hold this because we think this is a good opportunity here. We're probably going to go higher. We're already up $700. This is fantastic. We're up $900. This is great. Okay, so now we're going to hold on to it. We think, hey, this is great. We're going to hold it. Oh, it started going down a little bit, but that's okay. But there's a lot of fluctuations in this. Now we're up 1,100. We were. Okay, now we're up 700. So we're up $706. Pretty good, except we had a drawdown of about $1,100, right? Now, on this side, we are going to do something a little bit different. We were up $700 here. And let's replay that just one more time.